Hello everyone, this is the last video this week, and in this video we will be talking about liquidity regulation. Australian Prudential Regulatory Authority APRA's Prudential Standard APS 210 liquidity was released in 2000, which is regularly modified and most recently in January 2014. The regulation replaced the regulatory reserve requirements and minimum liquid asset reserve portfolio requirements. The liquidity regulations aim to ensure that all authorized depository institutions have sufficient liquidity to meet obligations as they fall due across a wide range of operating conditions. Despite the elimination of mandated minimum liquid asset reserves in 2000, APRA requires that depository institutions have three things. First of all, a risk management framework to measure, monitor, and manage liquidity risk that is commensurate with the nature and scale of complexity of the institutions. A portfolio with high-quality liquid assets sufficient in size to enable the institutions to withstand a severe liquidity stress, and a robust funding structure appropriate for its size, business mix, and complexity. And high-quality liquid assets include cash, bank bills, and CDs issued by financial institutions, and at-call deposits. APRA's regulations place primary responsibility on the bank's board of directors and management to ensure that authorized depository institution has sufficient liquidity to meet obligations as they fall due. APS 210 requires that an ADI, Authorized Depository Institutions Liquidity Management Framework, be reviewed at least annually and include at a minimum the following 5 elements. First of all, the statement of the depository institution's liquidity risk tolerance, approved by the depository institutions board, a liquidity management strategy and policy of the authorized depository institutions approved by depository institutions board, operating standard, for example, policies, procedures, and controls for identifying, measuring, monitoring, and controlling its liquidity risk in accordance with its liquidity risk tolerance, a depository institution's funding strategy approved by the board, and last of all, contingency plan. So as we discussed earlier, in December 2010, the BIS Basel Committee, Bank of International Settlement, Basel Committee on Banking Supervision, announced reforms to strengthen global liquidity rules with a key aim of promoting a more resilient global banking sector. In line with depository institutions' size and complexity with respect to liquidity risk, APRA determines whether an authorized depository institution is classified either a liquidity coverage ratio, ADI, or an ADI subject to minimum liquidity holding regime for the purpose of APS 10. The liquidity coverage ratio requirement, the objective of the LCR, liquidity coverage ratio requirement, is the promotion of short-term resilience of an Australian authorized depository institution's liquidity risk profile. The LCR requirement aims to ensure that depository institutions maintain an adequate level of unencumbered high-quality liquid asset that can be readily converted into cash to meet its liquidity needs for a 30-day period under a significantly severe liquidity stress scenario. The stress scenario involved in the setting of the LCR involved both a depository institution specific as well as a market-wide stress situation. The LCR is a ratio and must not be less than 100% at any time. So you can see the value of a stock of high-quality liquid asset divided by the net cash outflows over the next 30 days must be greater or equal to 100%. The net stable funding ratio, NSFR requirement, was designed by the Bank of International Settlement, Basel Committee to further add weight to the LCR in the promotion of medium-term and long-term liquidity resilience by requiring depository institutions to fund their activities with more stable source of funding on an ongoing basis. The NSFR is more a test of funding soundness than the LCR and focuses on the establishment of a minimum acceptable stable funding base relative to the liquidity characteristics of a depository institution's assets and activities over a one-year time horizon. So LCR requirement is particularly for short-term liquidity soundness, whereas the net stable funding ratio is more for the long-term liquidity soundness. So specifically, the NSFR requirement is structured to ensure that long-term assets are funding with at least a minimum amount of stable liabilities. The NSFR is defined as the ratio of the amount available stable funding to the amount of required stable funding and must not be less than 100%. So this is the end of our discussion this week. Thank you very much.